This video will present real-world factors favoring a high dividend policy. We consider reasons why a firm might pay its shareholders high dividends even in the presence of personal taxes on these dividends. Let's look at the desire for current income. It has been argued that many individuals desire current income. The classic example is the group of retired people and others living on a fixed income. The argument further states that these individuals would bid up the stock price should dividends rise and bid down the stock price should dividends fall. This argument does not hold in perfect capital markets because an individual preferring high current cash flow but holding low dividend securities could easily sell off shares to provide the necessary funds. Thus, in a world of no transaction costs, a high current dividend policy would be of no value to the stockholder. However, the current income argument is relevant in the real world. Stock sales involve brokerage fees and other transaction costs, direct cash expenses that could be avoided by an investment in high dividend securities. In addition, stock sales are time-consuming, further leading investors to buy high dividend securities. To put this argument in perspective, remember that financial intermediaries such as mutual funds can perform repackaging transactions at low cost. Such intermediaries could buy low dividend stocks and, by a controlled policy of realizing gains, pay their investors at a higher rate. Let's talk about behavioral finance. Suppose it turned out that the transaction costs in selling no dividend securities could not account for the preference of investors for dividends. Would there still be a reason for high dividends? It turns out that behavioral finance also has an argument for high dividends. The basic idea here concerns self-control, a concept that, though quite important in psychology, has received virtually no emphasis in finance. Investors also must deal with self-control. Suppose a retiree wants to consume $20,000 a year from savings. In addition to Social Security and her pension, on one hand, she could buy stocks with a dividend yield high enough to generate $20,000 in dividends. On the other hand, she could place her savings in no dividend stocks, selling off $20,000 each year for consumption. Though these two approaches seem equivalent financially, the second one may allow for too much leeway. If lack of self-control gets the better of her, she might sell off too much, leaving little for her later years. Better, perhaps, to short-circuit this possibility by investing in dividend-paying stocks with a firm personal rule of never dipping into principal. Although behaviorists do not claim that this approach is for everyone, they argue that enough people think this way to explain why firms pay dividends even though, as we said earlier, dividends are tax disadvantaged. Does behavioral finance argue for increased stock repurchases as well as increased dividends? The answer is no, because investors will sell the stock that firms repurchase. As we have said, selling stock involves too much leeway. Investors might sell too many shares of stock, leaving little for later years. The behaviorist argument may explain why companies pay dividends in a world with personal taxes. Another factor is agency costs. Although stockholders, bondholders, and management start firms for mutually beneficial reasons, one party later may gain at the other's expense. Take the potential conflict between bondholders and stockholders. Bondholders would like stockholders to leave as much cash as possible in the firm so that this cash would be available to pay the bondholders during times of financial distress. Conversely, stockholders would like to keep this extra cash for themselves. That's where dividends come in. Managers, acting on behalf of the stockholders, may pay dividends to keep the cash away from the bondholders. In other words, a dividend can be viewed as a wealth transfer from bondholders to stockholders. Of course, bondholders know about the propensity of stockholders to transfer money out of the firm. To protect themselves, bondholders frequently create loan agreements stating that dividends can be paid only if the firm has earnings, cash flow, and working capital above specified levels. Although managers may be looking out for stockholders in any conflict with bondholders, managers may pursue selfish goals at the expense of stockholders in other situations. As you may know, managers might pad expense accounts, take on pet projects with negative NPVs, or not work hard. Managers find it easier to pursue these selfish goals when the firm has plenty of free cash flow. After all, one cannot squander funds if the funds are not available in the first place. And that is where dividends come in. Several scholars have suggested that the board of directors can use dividends to reduce agency costs. By paying dividends equal to the amount of surplus cash flow, a firm can reduce management's ability to squander the firm's resources. This discussion suggests a reason for increased dividends, but the same argument applies to share repurchases as well. Managers, acting on behalf of stockholders, can as easily keep cash from bondholders through repurchases as through dividends. And the board of directors, also acting on behalf of stockholders, can reduce the cash available to spendthrift managers as easily through repurchases as through dividends. The presence of agency costs is not an argument for dividends over repurchases. Rather, agency costs imply firms may increase either dividends or share repurchases rather than hoard large amounts of cash. Moving on, information content. While there are many things researchers do not know about dividends, we know one thing for sure. The stock price of a firm generally rises when the firm announces a dividend increase and generally falls when a dividend reduction is announced. The question is how we should interpret this empirical evidence. Consider the following three positions on dividends. First, from the homemade dividend argument of dividend policy is irrelevant. Given that future earnings and cash flow are held constant. Second, because of tax effects. A firm's stock price is negatively related to the current dividend when future earnings or cash flow are held constant. Third, because of stockholders' desire for current income. A firm's stock price is positively related to its current dividend, even when future earnings or cash flow are held constant. At first glance, the empirical evidence that stock prices rise when dividend increases are announced may seem consistent with position 3 and inconsistent with positions 1 and 2. However, other authors have countered that the observation itself is consistent with all three positions. They point out that companies do not like to cut a dividend. Firms will raise the dividend only when future earnings, cash flow, and so on are expected to rise enough so that the dividend is not likely to be reduced later to its original level. A dividend increase is management's signal to the market that the firm is expected to do well. It is the expectation of good times, and not only the stockholders' affinity for current income, that raises the stock price. The rise in the stock price following the dividend signal is called the information content effect of the dividend. To recapitulate, imagine that the stock price is unaffected or even negatively affected by the level of dividends, given that future earnings or cash flow are held constant. Nevertheless, the information content effect implies that the stock price may rise when dividends are raised if dividends simultaneously cause stockholders to increase their expectations of future earnings and cash flow. We discussed the last factor as dividend signaling. We argued that the market infers a rise in earnings and cash flows from a dividend increase, leading to a higher stock price. Conversely, the market infers a decrease in cash flows from a dividend reduction, leading to a fall in stock price. This raises an interesting corporate strategy. Could management increase dividends just to make the market think that cash flows will be higher, even when management knows that cash flows will not rise? While this strategy may seem dishonest, academics take the position that managers frequently attempt the strategy. Now we come to the incentives of managers to fool the public. Suppose you are a manager who wants to boost stock price. Perhaps because you are planning to sell some of your personal holdings of the company's stock immediately. You might increase dividends so that the market would raise its estimate of the firm's cash flow, thereby also boosting the current stock price. If this strategy is appealing, would anything prevent you from raising dividends without limit? The answer is yes, because there is also a cost to raising dividends. That is, the firm will have to forego some of its profitable projects. At some point, the market will learn that cash flow has not increased, but instead profitable capital expenditures have been cut. Once the market absorbs this information, the stock price should fall below what it would have been had dividends never been raised. If you plan to sell, say, half of your shares and retain the other half, an increase in dividends should help you on the immediate sale but hurt you when you sell your remaining shares years later. So your decision on the level of dividends will be based, among other things, on the timing of your personal stock sales. This is a simplified example of dividend signaling, where the manager sets dividend policy based on maximum benefit for himself. Alternatively, a given manager may have no desire to sell his shares immediately but knows that, at any one time, plenty of ordinary shareholders will want to do so. For the benefit of shareholders in general, a manager will always be aware of the trade-off between current and future stock price. And this, then, is the essence of signaling with dividends. It is not enough for a manager to set dividend policy to maximize the true or intrinsic value of the firm. He also must consider the effect of dividend policy on the current stock price, even if the current stock price does not reflect true value. Does a motive to signal imply that managers will increase dividends rather than share repurchases? The answer is likely no. Most academic models imply that dividends and share repurchases are perfect substitutes.